Welcome to our inaugural podcast, Fireside Chat. I know you guys have been doing these Fireside Chats for some time. We've talked about wanting to reach out to a larger audience, make this as timely and as accessible as possible to your clients, your affiliates, and anyone out there looking to gain information in the financial services space. And I'm thrilled to be joining you. I appreciate the offer to make me your facilitator through these events. Really excited to get started because I know we've got a lot of great content today. Before we jump in, any first words about moving to a podcast environment from the live sessions you used to do?
Yeah, so we listened. Oftentimes the timing wasn't convenient for folks, and we wanted to try to make these, as you used the word accessible, we wanted to make these as accessible as possible. Listen to them anytime you want to, if 10 o'clock's not convenient because maybe you work or maybe you've got grandchildren at that time. We don't want to compete with that. We want to be able to deliver these in a consumable way. And so this is our first attempt at trying to deliver it in a different way, and hopefully it's well received.
I love it. I love it. So thank you. Just for those of us that may be new to the Fireside Chat, what insights would you provide as far as for those new listeners on what can our listeners expect in this series going forward?
Hopefully we can deliver market-related data that they can understand and process in an easy format.
Yeah, and Jim, that's one of the reasons we invited you in, right? You've observed these over time, and we're going to try to make these a little more palatable. We want to provide the same robust information, but maybe in a way that can be easier to receive. I don't want to say the words less technical, but we want to try to deliver these in a friendlier way and try to get those concepts across that reinforce what we know technically, but maybe people can receive it easier in a slightly different way if you can help us interpret some of that stuff. We live in the forest, and oftentimes, that's both a blessing and a curse.
I will definitely take that as a challenge going forward. I know you guys have so much knowledge and built up technical acumen as it relates to this space. So I'll do my best to keep you honest and keep you simple for our listeners going forward. And with that in mind, I'd love to jump right in. So, one of the questions that we often get from your clients is, what decisions has the Federal Open Market Committee made, and how do they affect everyday people like us?
Yeah, so Jim, the Federal Open Market Committee is a committee of the Federal Reserve System that's charged with making decisions about interest rates and the growth of the broader monetary supply.
So, Shawn, that sounds great, but what does that actually mean for us?
Yeah, so they set interest rate policy. They have two goals, specific goals. Those goals revolve around employment and inflation. Inflation's been in the news quite a bit of late, and part of their job right now is to arrest or at least slow down the rate of inflation. For those listeners that don't specifically know what inflation is the change in a basket of goods and services that the consumers use on a daily basis.
That's price, right? We pay what we're paying at the store for groceries, what we're paying at the pump for gasoline to some degree. How much more does it cost you to buy the same stuff, right? Is that a fair way to say it?
Yeah, I would. That's the fairest way to say it, to be honest with you. And we see it every day as consumers because we're out and about shopping at the grocery store, pumping that gas, buying products and services online. It's that change in price.
I like it. Is there anything you guys would add to that?
So, Shawn, I'm gonna throw it back to you if I can. We'll throw the tennis ball around the table. So,
sure.
If we can add on to that, right? The FOMC, or the Federal Open Market Committee, their charge is a dual mandate, right? Two prongs: full employment, stable prices. And so, how do they try to maintain stable prices? What are the tools they use typically to maintain stable prices?
Yeah, so it comes down to accommodation or the converse of that, whether they want to rein in the economy. But with accommodation, they can attempt to lower interest rates to spur investment, to spur purchasing and whatnot. Conversely, when they want to restrict growth, they can hike interest rates to try to relax the economy, calm the economy down a little bit if it's getting out of hand or if it's growing too fast.
So we went through sorry, Jim, I'm stealing your thunder here, but we went through a recent pocket of high inflation. And so the Federal Reserve responded in kind with raising interest rates extremely quickly in historical terms to try to slow economic activity. In some ways, they've done that, right? We've heard the stories about the housing market and the lack of inventory coupled with the higher interest rates really putting some difficulty into that market, slowing it down and such. Also, to some degree, large purchases, right? So interest rates tend to affect large purchases like automobiles. Now, manufacturers have some pricing power, right? They can choose, if you finance with that company, they can choose to keep the interest rate artificially low because they've got the profit margin on the car. But if you go to just a bank, it's very conceivable that you've seen interest rates as high as 8 or 9% on an auto loan. So how effective has the interest rate policy been of the Federal Reserve in terms of getting inflation back in check, Shawn?
I'd argue it's actually been quite effective. Given that we came out of COVID, there was a lot of money thrown at a problem, the problem being COVID, and that we had a supply chain issue across the globe because of COVID. So in that regard, they had to this time tamp down on the growth, on the broader growth of the economy, given it had been fueled with so much money from both Congress as well as the Fed early on. And to keep this from spiraling out of control, they had to raise rates. Now, they raised rates in a very quick fashion, probably not the way they wanted to, but their goal, again, that goal is price stability and employment. And on the price stability side, the only way to really get to what they wanted to was that they needed to raise rates and start to slow the growth, which, as you remember, coming out of the pandemic, there was a lot of pent-up demand for travel, for purchases, for housing, for a whole host of things that led to a very high level of inflation that we had not experienced in decades in this country.
So, Shawn, we've had some recent economic data. How is that coming through? What is it looking like? Is there cause to be optimistic for inflation to continue to slow?
Yes, there's definitely cause for optimism. We've come off of much higher levels in the 6, 7, 8% range and seem to be settling in a 3 to 4% range. While that remains elevated versus recent past, that's not elevated in historical terms. And I could argue that that's a good place for us to be right now, given how much accommodation was placed on the economy. The Fed has a goal of getting to 2 or thereabouts. We're still a ways from that, but we've made lots of progress. And to the point where they're no longer going to be raising rates, their next move would be to cut rates. But that may take a little longer to come to fruition, given that inflation is somewhat sticky in that 3 or 4% range.
So there's been some questions that we received as financial planners about inflation. And I just want to clarify a little bit about how inflation works. We've had questions like, when are we going to see prices go down? And prices, sadly, they're not going to go down, right? The nature of inflation is not price reduction. That's called deflation. And that comes with its own set of difficulties and potentially problems for an economy. Inflation has the effect of stacking. So you won't necessarily see prices go down. You may see some prices go down. Eggs might go down, but something else might go up. And that's all in the basket that Shawn alluded to earlier. The important part is that we get price stability. Hot inflation is really a difficult thing. It really, wages don't keep up with the increases in prices, and it has the effect of deteriorating your paycheck. Stable prices, paychecks, and annual wage increases can keep pace with that. But when inflation's at 7 or 8%, it's extraordinarily difficult for employers to keep up with that because they're still selling at the same prices they were yesterday while their prices are going up for input costs. And there's this adjustment period that's very difficult. It's not really that quick. And it happens kind of all at once in terms of the price increases. So I know that might be a little bit messy, but the point is 8% plus 3% plus 3%. It stacks on top of each other. So we're looking for a cooling of the increases, not reductions in prices, is what I was trying to get to.
Yeah, we're looking for that D that's known as disinflation, Bill, not deflation. And the disinflation is the lower rate of price growth. That's exactly what we're looking for.
Yeah, I was much quicker to get to where I was going. Thank you.
Wow, that's all right.
So with that, I think, Jim, bringing you back in, we want to talk a little bit about, what do we do? Right? We're all human, right? This is a backdrop. What do we do at this point? Are there things that people should be thinking about in their own financial lives to make sure that they're advancing in their own financial security during these uncertain times.
So I love the discussion so far, guys. I think this helps not only, myself as one of your clients, but I'm assuming it's going to help a lot of people in really understanding the role inflation plays and just some of the implications associated with it. I am interested, though, to get your feedback on what are some of the simple strategies for investing that you will embrace or we as your client should be considering in these types of times?
Well, we're a financial planning based firm first, and Bill and Tony and some of our other advisors always say this, but you got to have a plan. You've got to have a solid, sound plan. It's got to be a financial plan first, not an investment plan. Investments are important, but without that financial plan to harness to, all this becomes a lot harder. So that's the first thing you need. Stepping into the investment side, we don't time markets. Timing markets are fool's errand. You've got to stay invested for the most part, and you've got to be cognizant of risk. After a large market run up, you may want to reduce some risk. When things sell off dramatically, you probably want to amp up risk. We always want to be exposed to the market, one, and we want to be exposed in a fashion that has risk as kind of a center point to why we're exposed. A prime example would be someone who's a moderate expression on allocation can't be 100% equity. It's just too much risk for what their allocation is, and we've got to stay harnessed to what those allocations are.
Thanks, Shawn, for bringing financial planning up first. It's so important. And there are all sorts of data points, right? And Jim, I'm going to throw this over into your camp. There's the Harvard business study of people that wrote down their goals versus the people that didn't write down their goals when they graduated from Harvard's MBA program. And the people that wrote down their goals were wildly more successful than the people that didn't write down their goals. So first and foremost, that's one of the things a financial plan does, is it clarifies your goals and it creates a pathway to get to those goals. And so anchoring back to that during times of stress, uncertainty, deteriorating confidence, and I'm not just talking about deteriorating confidence in markets, I'm talking about just if you're feeling anxiety and deteriorating confidence in what might be happening, look at your plan. Your plan may not be deteriorating. The plan contemplates an uncertain future. It's built into the DNA of it. So I would suggest that's a good first exercise. Review your financial plan. Second, review your investments. As Shawn was saying, review to make sure you're taking the right amount of risk for you, not for somebody else, not for the neighbor down the street, not for whatever Jim's harebrained idea is that he's going to throw at us. Sort of an inside joke. But for you, we all have our own internal constitutions based on our life experiences and makeup. And all that means is we react to risk differently. Some of us have a much more visceral reaction, emotional, gut-wrenching. Others, they don't see it as a problem. So you have to have a portfolio that's compatible with you. And that's what Shawn was saying about if you're a 50-50 investor, being at 100-0, you might be greedy. But as I like to say, risk presents itself at inconvenient times. And it's oftentimes when you're stretching to make a couple extra bucks that the market will remind you shouldn't have. And so I would suggest all of those, make sure there's an integration between your plan, your investment expression, make sure they're compatible and they're compatible with you. Both are compatible with you and your life goals.
Yeah, Bill, that resonates a lot, and I'm sure it does with our audience as well. We could likely create a whole separate podcast around just emotional decision making as it relates to the market or risks that we're facing. But, how would you synthesize that, either of you guys, in one or two sentences around how to manage emotion in uncertain times? What are your recommendations?
We have to realize that what our fears are generally when we're talking about investments, the markets have never gone to zero. But I can't tell you how many times I've heard people say, markets are just going to go to zero, so what's it matter anyway? And we have to understand that we weight risk and negative outcomes approximately twice as high as we do positive outcomes. And I think I got that right, but I'm going to wait for you to confirm it.
Yeah, to be honest, you're probably right on the data point. It's exponentially higher that our brains are wired to go to the negative.
And so this is really, we have these conversations, believe it or not, it's not just for podcasts. We talk about this as a team, the three of us, a lot, and that we're all wired completely incorrectly when it comes to investing. Our limbic system, which is why we weight negative stimulus higher than positive stimulus, keeps us protected from danger. And our body is responding to danger. And it takes either training or counseling, and I don't mean Jim's counseling, I mean our counseling, to overcome that stimulus, to be able to respond in a different way to it. Logic overcoming emotion is really difficult. I would argue it's impossible. And it's only through kind of an elastic response. In other words, you experience it and you create an elasticity in your own emotions to it. You're steeled to it over time. And so those are things that we have to recognize it first, right? That this is an irrational response to a world stimulus, that the world probably isn't going to end, that markets aren't going to zero. And as one, and I can't remember where I heard this from, but the beauty about the world ending is it only happens once. And it's really hard to bet on that. So I don't know where you take that, Jim, or unpack it, but there's a few nuggets in there to have fun with.
No, I appreciate it. And like I said, I think we can probably get into a much deeper conversation of what does this mean for your clients and the interactions that you currently have and the roles that you play above and beyond advisor and investor. It's, how are you serving as the counselor and the emotional support and all of the other things when the value of our assets fluctuate on a daily basis. So yeah, I'd love to dig into that a little more, but I think this is a good starting point and a good stopping point. I think these were some good questions for today. I do appreciate the insight. I like the fact that we're able to share this information and hopefully what will be, again, a more accessible way for our audience. But I just want to say thanks for including me, guys. I appreciate it. Any last words of wisdom before we sign off?
No, I'll just thank you, Jim, because I thought you were really helpful in keeping us on track.
Yeah. All right. Thanks, guys. Appreciate it. Thanks, everyone, for joining. And hopefully we'll see you all soon.